morning. My name is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about charitable gifting. What constitutes a gift to charity? A gift to charity is simply a gratuitous transfer of property to a charitable organization. The key is that your gift must be in some kind of property. Your time or personal services do not count. There are several different types of property that can be donated to charity, and a gift is limited only by your imagination. Are you the type who wants to donate cash, stock, or your lunchbox collection from a 1960s sitcom? How do you decide whether to donate to charity? The decision to donate to charity is a special and a personal one. Although the IRS does not require that you have a charitable motivation when you donate to charity, you can do it strictly for the tax benefits. Most people who decide to donate to charity have a charitable intent. There are an infinite number of charities from which you can choose from. Most people have a particular charity in mind when they decide to make a contribution. So, what are the tax benefits of donating to charity? Through tax legislation, Congress has attempted to encourage charitable giving because it is good social policy. Most every charity depends on individual contributions to remain financially solvent, especially in this era of fewer direct government dollars. As a result, charitable giving has become interconnected with the tax laws, which have grown more and more complex. Congress has sweetened the pot for taxpayers who donate to qualified charities. First, you generally receive an income tax deduction in the year you make the gift. Second, you do not have to worry about gift tax because federal gift tax does not apply to charitable gifts. Third, the charitable gifts serve to reduce your taxable estate, thus reducing your potential estate tax liability. For more information, see charitable deduction. It is this last tax area, estate tax, where charitable giving may produce the greatest tax benefits. Over the next 30 years, an estimated $8 trillion of assets will pass from one generation to the next, resulting in the assessment of significant estate taxes. One solution to minimize these estate taxes is charitable giving. But what options do you have for donating to charity? One is an outright gift. In the typical situation, your gift will be for the charity's benefit only, and the charity will take possession of the gift immediately. This type of gift is called an outright gift. This arrangement satisfies the general rule that a gift to charity must be paid to the charity in the form of money or property before the end of the tax year to be deductible for income tax purposes. Another option is split interest gift in trust. Another option is for your gift to be split between a charity and a non-charitable beneficiary. Here, one party, usually the non-charitable beneficiary, receives the use of the donated property for a specific period of time, which means he or she is paid a certain sum every year out of the donated property. Then, after this time period is up, the remaining property passes to the charity. Such a gift can be used to provide for a dependent child or surviving spouse. In this arrangement, a charity's right to the enjoyment and possession of the gift is delayed because the non-charitable beneficiary has the first interest in the donated property. Ordinarily, this delay would mean no tax deductibility for the gift. However, Congress has voiced its approval of such arrangements as long as the gift is set up as one of a number of special trusts expressly created for this purpose. If your split interest gift is set up as one of these trusts, you receive federal income, gift, and estate tax deduction. One of those trusts is a Crat, C-R-A-T, Charitable Remainder Annuity Trust. A Crat is a split interest gift between a non-charitable beneficiary and a charitable beneficiary. The non-charitable beneficiary has the first interest, and the charity has the remainder interest or second in line interest. The trust pays out a fixed amount of income every year, an annuity. to the non-charitable beneficiary for the term of the trust, and the remaining assets pass to the charity at the end of the term. Another trust is called a Crat, C-R-U-T, a charitable remainder uni-trust. A Crat is a split interest gift between, again, a non-charitable beneficiary and a charitable beneficiary. As with a Crat, the non-charitable beneficiary has the first interest and the charity has the remainder interest. However, instead of paying out a fixed amount each year, a Crat pays the non-charitable beneficiary a fluctuating amount each year, depending on the value of the trust assets for that year. This amount is calculated as a percentage of the assets in the trust on a specific date each year. At the end of the trust term, the remaining assets pass to the charity. Important tip, there are several varieties of Crats: NI Crats, NIM Crats, Flip Crats, each with slightly different rules regarding how the non-charitable beneficiary is paid. Another option is pooled income fund. A pooled income fund is a split interest gift between a non-charitable beneficiary and a charitable beneficiary. Like the Crat and the Crat, the non-charitable beneficiary has the first interest and the charity has the remainder interest. A pooled income fund is managed by the charity, much like a mutual fund, right? And is made up of donations from several donors. The charity pays the non-charitable beneficiary a fluctuating amount each year, depending on the value of the fund in that year. These income distributions are made to the non-charitable beneficiary for his or her lifetime, after which the portion of the fund assets attributable to the non-charitable beneficiary is severed from the fund and used by the charity for its charitable purposes. Another option is a charitable lead trust. The charitable lead trust is a split interest gift between a non-charitable beneficiary and a charitable beneficiary. Here, the charity has the first or lead interest, and the non-charitable beneficiary has the remainder interest. The charity is paid a certain amount every year for the term of the trust, and then the remaining assets pass to the non-charitable beneficiary at the end of the trust term. Another option, bargain sale. A bargain sale in the context of charitable giving is a sale to a charity at a bargain price. A price below the fair market value of the item sold, fair market value is being the price a willing buyer would pay a willing seller in an arm's length transaction. The difference between the sale price and the actual fair market value of the asset equals the donation to charity. A bargain sale involves two separate transactions for tax purposes: a sale and a charitable gift. The IRS treats each event as a separate transaction. Consequently, each is reported separately on your income tax return. Another option, a private foundation. Donors with sufficient resources may want to create a private foundation. A private foundation is a separate legal entity, often named for the donor, that can endure for many generations after the original donor's death. The donor creates the foundation, then transfers the assets, typically appreciated assets, to the foundation, which in turn makes grants to public charities. The donor and his or her descendants retain complete control over the charities that receive the grants. Community foundation is another type. A type of organization related to a private foundation is called a community foundation. A community foundation concentrates its activities within a defined geographic area and is typically controlled by a representative group of community members, which may include the donor. In practice, a community foundation is a public charity, though it appears to share some of the same characteristics of a private foundation. And last, you could set up a donor advised fund. Similar in some respects to a private foundation, a donor advised fund known as a DAF, D-A-F, offers an easier way for a donor to make significant charitable gifts over a long period of time. A DAF actually refers to an account which is held within the charitable organization. The charitable organization is a separate legal entity, but the donor's account is not. It is merely a component of the charitable organization that holds the account. Once the donor has transferred assets to the account, the charitable organization becomes the legal owner of the assets and has ultimate control over them. The donor can only advise, not direct, the charitable organization on how the donor's contributions will be distributed to other charities. Charitable gifting strategies are not easy, and your ideal strategy will ultimately depend on your circumstances. As a financial advisor, one of the most rewarding aspects for me is helping clients incorporate charitable giving into their financial plan. If you have any questions about charitable gifting, do not hesitate to call Cortburg Retirement Advisors at 212-776-4094. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to subscribe to my YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.